Imagine waking up, checking your phone, and seeing a sudden geopolitical headline has sent global oil prices spiking overnight. That is the reality of the 2026 market. We have a long-term structural transition toward electric vehicles, actively colliding with tight real-world oil supplies. Faced with this extreme volatility, intermediate traders often struggle. They react emotionally to the headline noise instead of decoding the underlying macro system driving the asset. When headlines move faster than a retail trader can react, a top-down strategy provides a framework for navigating that noise. This begins by identifying the specific macro drivers of the exact asset you are trading. This brings us to the first choice, WTI or Brent. They operate in entirely different logistical ecosystems. West Texas Intermediate is the U.S. benchmark. Because it's landlocked, its price is heavily dictated by North American supply lines and localized storage limits. You can see that localization here at the primary storage hub in Cushing, Oklahoma. If these tanks fill up, WTI prices can disconnect dramatically from the rest of the world. Brent crude, on the other hand, originates in the North Sea. It is a seaborne global benchmark. That easy ocean transport makes Brent highly sensitive to international supply chain disruptions and overseas conflicts. If you want to read price signals accurately, you have to deliberately align your strategy to the specific logistical and geopolitical realities of the benchmark you choose. Once you choose your market, you have to execute. When trading oil with a broker, you are usually trading a contract for difference, or CFD. You never take physical delivery of the barrels. You are strictly speculating on the price difference between when you open and close the contract. With leverage, trading 100 WTI barrels doesn't require $9,000 cash. You control massive volume using a fraction of capital as margin. But there's a hidden cost. Oil CFDs use underlying futures that expire. Brokers must roll your position to a new contract. On top of that, holding these leveraged positions overnight incurs daily financing fees called swaps. If you hold a long-term position, these daily fees directly eat into your profit margins. For traders holding positions over days or weeks, these rollovers and swaps represent a significant portion of the total cost of carry. Factoring them in early prevents these invisible fees from eroding a winning trade. All the leverage in the world won't help if you get shaken out of your open position prematurely. Placing a tight, arbitrary stop-loss in the oil market ensures that normal daily volatility will trigger it before your trade can mature. To fix this, we use the average true range, or ATR. It is a technical indicator that measures the actual current volatility of the asset. A static stop gets clipped by market noise. Using a 1.5x multiple of the daily ATR gives the trade breathing room. As that stop loss widens, decrease your total trade volume. This ensures your maximum risk remains strictly limited to 1 to 2% of your total capital. By using the ATR to define the stop loss and adjusting the size of the position accordingly, the risk on every trade is capped mathematically before it is ever executed. Looking ahead to 2026, the oil market is shifting. Instead of long, continuous bull or bear trends, we expect tight trading ranges punctuated by sudden, violent volatility spikes. Those spikes are largely driven by years of underinvestment in new oil exploration. We are looking at a fragile global supply chain that is highly susceptible to sudden shocks. Global alliances control millions of barrels of that tight supply. Policy decisions and production quotas set by OPEC+ will continue to be the biggest trigger for overnight price gaps. The actionable strategy for this environment is range-bound trading. You buy near established support, sell near resistance, and keep those ATR-based stops strictly in place to protect against the sudden shocks. Thriving in 2026 requires this complete top-down approach. You have to respect the global fundamentals, choose the right regional benchmark, and strictly enforce technical risk management on every single CFD trade. To put this top-down strategy to the test, open a risk-free FXNX demo account today. You can practice navigating oil volatility with 0 pip spreads and ultra-fast execution.